Good afternoon on a Friday. This is Louis Llanes with Market Coffee Talk. I hope you're doing well. Today I'm going to be talking about what's on my hat. This is my Chartered Market Technician's hat. Some of you may know that I'm also have the designation of a Chartered Market Technician, which is a 3-year educational program that's really designed to help people understand how to analyze markets. So as you see investment strategists in Wall Street that have this designation, it's really designed to understand the supply and demand for the markets themselves. And today I'm going to be talking a little bit about some of the things that I think you might start hearing in the near future analysts talking about. And because some of these things are starting to set up in a way where people are going to start setting upside targets for where the market will go. And I think you might hear some analysts say, hey, the market is probably going to either slow down or maybe even top at these levels. Whether or not I will go along with that recommendation is another issue, but I think you're going to start hearing about it. So this is kind of like a heads up to talk about that. So I'm going to go ahead and share my screen with you. So, and I'm going to be going over the S&P 500, okay? As you know, the S&P 500 is an index that tracks the largest companies in the really the 500 largest companies in the United States, and it represents the majority of the market capitalization. So it's most of the market itself. So it's a pretty decent proxy to be looking at. And one of the things I'm going to be looking at is the market from the most recent drop that we saw back in March, right? So this is the weekly chart of the S&P 500, and what we're looking at here, this top chart is a candlestick chart that shows the open, high, and low close relationship on a weekly basis. So each bar represents 1 week, and then we have some moving averages, and they're fairly long-term moving averages. And actually, I'm going to change these moving averages to, since we have weekly data, I'm going to change them to 13 weeks, 26 weeks, and 52 weeks so that we can have the time scale that I want to be looking at. And then on this MACD, we're going to be fine. Okay. So what these other lines are, they're moving averages. We're not really going to be looking at the moving averages more other than to talk about the trend. So when you look at a chart and when you're looking at the supply and demand of a market, a good way, one of the ways that I've come up with that is a good way to kind of have a quick way of analyzing is to do what's called a torque analysis, TORQ. T stands for trend, so I'm going to start with the trend. So first of all, we look at the lows and we look at the highs, and basically what we see is we have higher lows and higher highs, and that obviously means the trend is up. And we also see the moving averages. The shorter term moving averages are higher than the longer term moving averages, so we have a uptrend. It's pretty basic. All you gotta do is look at the chart and you see that. So the trend is positive. So the idea is that the trend is your friend until it bends at the end. So right now we're still in an uptrend. Now O in the torque formula stands for overbought, oversold. And what we're looking at there is to what extent has the market accelerated and gotten ahead of itself. So an overbought condition would mean that the market has moved very quickly to the upside and is due for a breather. And an oversold would be the opposite. It's moved down very quickly and it's probably due for a bounce up. So this bottom indicator is a moving average convergence divergence, which is kind of it's really just an analysis of two different moving averages, pretty basic indicator. But when this goes down negative like this, it's oversold, and potentially you could have reversal higher. So we saw, when we had the pandemic, we got into a severe oversold condition, and since then we've been in a bull market. So the low occurred on March 27th here of 2000. From this high to the low, we had a 35.43% loss, over 35% in a very quick period of time. In fact, when you go through market history, you do not see that amplitude of decline that fast very often. In fact, I'm not sure that we even saw that. I'd have to go back and look at that. But anyhow, so that was a big drop, right? Since that low in March 27th, we've gone all the way up to 41.85, but that low was 21.90.91. So that is a pretty nice snapback. We were coming from, obviously with the pandemic, et cetera, we were, there was a lot going on there. But one of the things that I think you might start seeing now is analysts coming out and talking about what's called Fibonacci extensions, or you might even hear the term Gann, or other types of overbought type indicators. Basically, there's some methods that you can look at from a technical perspective to get an estimate about what the upside target should be. The first one that I'm going to talk about here is a measured move. A measured move basically says, okay, if you look at market data, a lot of times what you'll see is a stock market or any bond market, whatever kind of market, when it has a higher and low, a big up and down, usually a reasonable upside target would be a measured move from the high to the low, and you tack that on top of the previous high, and that gives you a measured move to the upside. If you look at that calculation right now, the high on February 21st was 33.93, the low was 21.91. That's 1,202 points. So if you add that 1,202 points on top of that high, that gives you a target of 45.95. So the S&P 500 upside target on a measured move is 45.95, and we're right now at 41.85. So if we did hit that target, that would be another 9.8% move from here to the upside. Totally reasonable. And even then, a lot of times markets will overshoot those upside, those measured moves. But so that's something that I think a lot of technicians are going to be looking at. You might even hear, if we get around that 4,500 level, you're probably going to hear people starting to sound alarms and things like that. I would not take too much heed to that. It's just kind of something that you want to put in the back of your mind. As long as the markets are acting, fairly orderly, so that you have, volume is not accelerating higher when the market is heading down. You don't have churning action, stuff like that. Then the market can go much higher from there. But that's something I think you're going to start seeing. So my point today is just to talk about what I think you might start hearing out there, and to be have a heads up for that. Another popular way of looking at high targets would be using what's called Fibonacci extensions. And if you look at a Fibonacci extension, they're basically ratios based on the Fibonacci sequence. If you look at that, and it would take a little bit of time to explain that, but basically the Fibonacci kind of style of looking at upside targets is based on these ratios that you see in nature a lot. And it's uncanny how emotional social sciences tend to follow them. We tend to be natural creatures, obviously, and we tend to have emotional cycles that match these ratios. So the next ratio is the 1.618 ratio from the high. And just to kind of bottom line it, that would give an upside target of 44.51, which is be a little bit less than a measured move target. So for that reason, that, because we're getting closer to that level, and also because there's also Fibonacci time sequences that people look at, and Elliott wave analysis, there's other methods that are kind of sounding like, hey, cautionary signals if we get to these ranges. I think you're going to hear some analysts talk about that if you get to those areas. So sometimes you'll get a pause around that time, and that could get people thinking about selling, and you don't want to be that person where you're reacting. So I think we're in what's called a trim and trail market, where you should focus in on those stocks and those investments that make a lot of sense. Think long term. Don't let these short term traders make you lose your game, right? You don't want to be in a position where you're not on your game as a long term investor. But I do see those types of concerns probably coming up. Just be on the lookout for them. And that's really all I had for you today. Wanted to talk a little bit about those targets that a lot of analysts will probably be looking at. Hope you're doing well. Hope you have a great weekend. That's all for now. Talk to you later.